I think I'm exceeding Larry David's statute of limitations, wishing everybody a happy new year so far into the year. But happy new year, everybody. Welcome to 2023. We hit the ground running this week. We got the December jobs report. Some are calling it Goldilocks. I'm calling it Goldiless. Mortgage rates, the hard edge is certainly coming off now, and we're also losing this extra layer of pricing. I'm going to call it the fear factor layer that is chilling out. 2022 and 2023, of course, are huge transitional years for the real estate market. And these pre-approval letters going out there could be the best or worst thing that you got that day, depending on your source. And I've got some predictions for 2023 that you might not be that surprised by. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills. Hope you had a great week. All right, well, we got the jobs report for December, 223,000 jobs created. Wall Street was expecting 200,000. Again, that is not an impressive number for me, neither the expectation or the actual number. I believe the economy 20 years ago needed 400,000 for it to be a good jobs report, but everyone's calling it a Goldilocks report. And the reason they're calling it Goldilocks is it's enough of enough jobs created, the economy's not falling apart, and it's not too many jobs that's going to make the Fed more aggressive when raising rates. So if you see the stock market today rallying a bunch, bond market rallying a bunch, this jobs report was Goldilocks. I actually would like to see more jobs created, but that's just me. We hit a 3.5% unemployment level. That fell about 0.2% from the previous measured period. I guess that's good, but I have a lot of questions always about the unemployment rate. Who falls off and who can't be counted anymore? That's a big number, of course. Wage growth did not exceed expectations, and this doesn't make me happy because I always talk about the difference between a job and a career. And when we see wage growth go up, that will be a signal that folks are entering more career work than job work, and I've defined this before, in my opinion. Jobs, of course, are the basis of the economy. Everything plays off of jobs. Confidence and people's actual pocketbooks are going to be based on their jobs. So we got a jobs report today. Not impressive, but the markets, both stock and bond, loved it because they think the Federal Reserve could chill out a little bit. All right, mortgage rates. The hard edge seems to be coming off. We've got a 350 and change yield on the 10-year today, down a bunch today after the jobs report, about 15, 16 basis points or so. We're down from a recent high a couple months ago of 4.2. Not only are yields elevated, but there's also in mortgages a fear factor layer that some lenders have in place, which makes things artificially higher than they even should be on a natural high basis. And it looks like, I'm not going to say it looks like it yet, it feels like this fear factor layer, which I'm going to call it in mortgage pricing, is dissipating a little bit. So hopefully that trend continues and some lenders get back in the market and beat each other up a little bit and try to get the business. But as rates go down, and God willing here they'll continue, affordability obviously goes up. And the consumer appetite actually, oddly enough, goes up. There's not a difference really in anyone's life if they're paying a 5.99% mortgage or a 6.125% mortgage. But I'll tell you, in real practice, people really take to those numbers. So the attractiveness is coming back in. And then, as rates move down, folks will be more confident in their real estate moves as there's going to be less uncertainty coming out there. So my guess for mortgage rates this year, as I mentioned last week, we're going to get back in about the mid-4s by the end of the year. And at that point, we might start seeing some lateral buyers and sellers once again. Because right now, the lateral movement is very frozen for that matter. Because a lot of folks are in love with their mortgage, as I always talk about mortgage love. And even if they don't love their house, they love that mortgage. So it's going to be tough to get them to sell it. Moving on, I mentioned the pre-approval letter. It is the best and worst thing in the real estate business. Essentially, when a mortgage broker like myself writes a pre-approval letter, it sets off of a chain of events that you have to imagine end up with a moving truck or two. So, I've been getting a lot of calls lately from a lot of my agents of mortgage brokers and loan officers not calling back, not giving clear information. And, I've said this before. No escrow, if properly vetted and if a proper pre-approval is written, should ever close late. And there should be no real heartache during the transaction. So, a lot of times right now, my realtor friends, you're going to meet a lot of mortgage brokers that are weak and desperate. Now, I'm going to use those words because they're true. I've been doing this almost 20 years now, and I've seen a lot of things. So when you get a pre-approval letter that's from a weak or desperate mortgage broker who just wants to get the deal in the door, not sure if it can close or anything like that, most of my agents have a gut feeling about that, and here's my advice to all agents. Go with your gut. If you think something is off on the pre-approval letter, if something's not lining up, if you're not getting, proper communication, or if you are getting a lot of communication, it's not just hot air being blown at you that everything's great and the deal's done and it's all set, because it isn't. It's a mortgage. It's a process. Anybody who's tenured in this business knows that. Nothing happens overnight, for the most part in this business. So as an agent, listen to your gut. Stay away from those weak and desperate mortgage brokers, as they literally have no respect for what we're doing here. They have no respect for their own business, in my opinion, because they're putting their name on that pre-approval, and it is causing a lot of people a lot of heartache. And talking to my real estate agent friends, it looks like the number one reason for fallout right now is bad pre-approvals. So really easy way to put an end to it. Check your pre-approvals. Go with your gut. If they're not giving you the right answers, try to find somebody else to talk to on your client's behalf. Moving on to my predictions for the year of 2023. All right, here we go. I'm not Nicholas Copernicus, but and I know nothing, but here's my best guess at all of this. I think the stock market, not just the Dow, I think if you take the average of the Dow, S&P 500, and the NASDAQ, we're going to have a sideways market this year, flat to sideways. I say up or down no more than 10% for the combined numbers of the three major indexes, up or down by no more than 10%, and I believe it's back to a stock picker's market. A rising tide will not lift all boats. The Federal Reserve's not coming in with any parachute money. So stocks, expect a sideways market, expect a stock picker's market. 10-year Treasury, the bond market. I keep saying I think rates are going to end up in the fours by the end of the year, or maybe sooner than later. In order for that to happen, the 10-year Treasury has to sit around 2.5% or so. Right now, we're about 100 basis points higher than that. About 2 months ago, we were about 180 basis points or so, 170 basis points higher than that. I don't think I'm going out on a big limb here saying the 10-year Treasury will finish the year somewhere in the neighborhood of 2.5%, having mortgage rates finish the year on a 30-year fixed traditional mortgage somewhere in the 4.5% range. We will, of course, see. Gas, oil, and energy prices, 100% going down this year. Not only are things coming back in line to some normality, but I really do believe that the alternative energy push is going to be greater, is going to be felt greater on a move-forward basis for the next couple of years. And I think gas and oil and energy, for that matter, is going to be down in price. Inflation, it's going to moderate. It already has moderated. We're seeing it. It's happening big time in many different sectors. Supply chain will, of course, improve because most of us are back at it. When I say most of us, I mean most of the world's back at it and doing things again. And, here's my big prediction. The Federal Reserve will cut rates this year. Now, who knows if I'm right, but the way I'm seeing it, they're going to see a very weak economy probably in the latter half of the third quarter, beginning of the fourth quarter this year, once all of their rate hikes have worked their way into the system. And they're probably not done yet, for that matter. But I think we're going to see a Federal Reserve rate cut because, as I always say, in order for the Federal Reserve to cut rates, they need to raise rates first. And I believe that's what they've done here. Okay, everybody, that is my show for this week. Thank you, as always, for watching. And if you have any mortgage or real estate-related questions, please don't hesitate to reach out to me. Have a great, wonderful weekend. Please be safe, and thank you as always.